My name is Craig Iskowitz. I'm CEO of Ezra Group. We're a consulting firm for RIAs around technology and operations. And I'm the moderator for this panel, Investing in Venture Capital Made Easy with Fundrise and Allocate. Let me start off with a question. Are alternatives really alternative anymore? More financial advisors than ever seem to be adding alternative assets to their client portfolios. When asked about their future intentions, 44% of advisors said they plan to maintain or increase their allocations to alternatives in the coming year. And that figure jumps to 58% with RIAs at over $500 million in assets. Now, this doesn't mean that alts are taking the place of equities and fixed income, which are the most popular asset classes. And while alternatives aren't becoming more traditional per se, 2023 might be the year they go fully mainstream. Now, Futureproof recognizes this trend. This is the 5th panel on alts at this conference. So let me introduce our panelists. We have Saira, Rahman, VP of New Investor Initiatives at Fundrise, am I right? And John Felix, Director of Investments and Head of Emerging Managers at Allocate. All right, first question goes to Saira. Can you give us a 30-second elevator pitch for Fundrise?
Yes, absolutely. So Fundrise is an alts platform. We were the original alts platform that launched the first Reg A e-REIT a little over a decade ago. And we currently have venture capital, private credit, and real estate on our platform, accessible DTC. We were also the first robo-advisor for alts available in this space. We currently have $7 billion on the platform, over 500,000 users, and we're an investor-first platform, meaning we think about our investors as part of our mission all day, every day.
Excellent, Sarah. So sticking with you, a recent survey from Investment News found that 84% of advisors will use at least one alternative in their client portfolios. Now, Fundrise has had success with democratizing real estate investments. Why are you launching your B2B access to venture capital investments for advisors and fintechs?
Yeah, so definitely starting in the DTC space, I think it made a lot of sense for us to start exploring additional avenues once we started seeing investors want to be able to access us via intermediaries. So once we saw that people were interested in our tenured performance outside of just our own platform, we decided to launch the B2B side, particularly recently with all the interest we've seen in both venture capital and in credit.
Excellent. All right, John, thanks for flying in last night. John wasn't on this panel till just recently. Someone bailed out on us, and he was nice enough to fly in just for this panel, so thanks, John. Can you please give us a 30-second elevator pitch for Allocate?
Yeah, sure. Thanks, Craig. So Allocate's a digital operating system that helps all sorts of qualified investors, family offices, wealth advisors, individuals build out and manage their alternative portfolios. So we pair curated access to high-quality alternative funds with software solutions to increase transparency and portfolio reporting. We take a real quality-first approach where we've built a team of folks who have over 100 years of venture investing experience. And so we can access really high-quality funds because access is important in venture, and then we layer on software solutions to help solve some of the transparency and reporting issues as well.
So, John, why should advisors, with so much access to other alternative options, why should they include venture capital in their allocations?
It's a good question. So, I think fundamentally, if you believe in innovation and you believe that innovation is only going to continue to accelerate, then you have to be in venture. I think we all know that private companies are staying private longer before they go public. Amazon, when it went public in the late 90s, went public at a market cap of less than $500 million. And if you bought into that IPO, you would have made literally thousands of times your money in the public markets. It's just almost impossible to do that today. Companies are going public at $1, $5, $10, $50 billion valuations, and all of that value is accruing in the private markets now. So if you don't get in early and you don't get in the private markets, it's going to be a lot tougher to make that many multiples of returns. Stripe is one of the kind of fundamentally generational companies that's been built in the private markets over the past few decades. Anywhere between $50 and $100 billion company, depending on where you're holding it. If you bought Stripe and you tried to make the same multiple in the public markets that you did if you bought into Amazon's IPO, Stripe would have to become like a $500 trillion company, and so which is crazy. And so if you fundamentally believe in innovation, you have to get in early. You have to access these companies in the private markets.
Thanks, John. Over the past decade, the amount of capital invested in private markets has increased dramatically, nearly tripling from $4.5 trillion to over 12.5 trillion by the end of last year. So it's not surprising that startups like Fundrise and Allocate have built tools to facilitate financial advisors' access to alts. So Saira, what were some of the challenges you ran into building your technology to offer VC investments to advisors?
Yeah, and you guys will have to excuse me. I have some of my notes down in my lap because I have a 1-month-old at home and he woke up 4 times last night.
That's no excuse. We're all here.
I'm trying. So probably the biggest challenge at Fundrise specifically is that we were notoriously known as a real estate private equity platform. So our brand for the last 12 to 13 years has really been centered around that idea of excellent real estate returns. So shifting into venture capital was one that made sense if you think about it from the fact that we have fully built out the value chain top to bottom in real estate and realistically only had to attach on a few separate pieces in order to make venture work as well, because they're very, very similarly set in terms of product, the underlying product, I should say. But shifting the branding was probably the biggest. The next thing that was probably difficult was really figuring out which parts of the value chain we needed to build out in addition to what we had for the real estate. And then lastly, we had to rebuild our top of funnel. So because we had such high demand for the venture capital side initially, we had a wait list for a lot of people in order to access our venture capital. And until the last few weeks, we really did not have access to everyone to our venture capital product whatsoever.
I wouldn't say you're notorious for real estate investing. You're famous for real estate investing. You're one of the largest real estate platforms around. Can you talk a little bit about that and what goes into that?
Absolutely. So we own everything within the value chain. We source all of our own transactions. We underwrite all of our own transactions. We have some assistance with managing the properties, but realistically, that's still held closely to our chest. We also build out all of our funds, so all of the JVs are in-house at Fundrise, and then we manage all of our investment vehicles as well. So whereas I think a lot of fintech companies are primarily engineers, our engineering team is essentially as large, maybe slightly larger, than our accounting and finance team, which is really the brains behind the operation.
You're also a very different model in that you run the funds rather than just being a marketplace.
Correct.
Why did you go for that?
Well, initially we did start as a crowdfunding platform, so our first few deals were crowdfunded, and then we realized that there's a much bigger market, and it's much better for our investors for us to own the investment vehicle as well. It significantly lowered the costs of the actual e-REITs and all of our underlying investments when we were able to achieve that. So once we started launching those in, call it 2015, 2016, we really started accelerating the number of investors on our platform.
60% of financial advisors, according to a recent survey, expect private markets to outperform their public counterparts over the next 12 months. So John, most RIAs that I work with, they don't really understand alternatives in general, but venture capital specifically, so which might make them hesitant to incorporate it into a portfolio. So what is your firm Allocate doing to educate advisors about venture capital?
Yeah, so we do a lot of education. We do regular webinar series, Venture 101, Venture 201, Venture 301. If you haven't invested in venture before, it's a very new and different asset class for you. There's a lot of weird dynamics. Not all your capital is called up front. It's a very liquid asset class. You have to deal with distribution management. And so we write a lot of content. We do a lot of education. We want our investors to be really informed before they invest because venture is a risky asset class, but you can also do really, really well in venture. But we don't want our clients to call us, 3 years in and be, why is my IRR negative? And then we have to explain the J curve. So we do these things up front, and we spend a lot of time, building out portfolio models with our clients, coming up with a plan. We don't want them shooting from the hip and making commitments here or there. We really want them to be committed to investing consistently throughout the cycle, and we want them to be informed. And so we do a lot of education, webinars, writing thought content. We host events. We do a lot.
That's terrific. And with something you mentioned earlier about Stripe and other IPOs that had tremendous returns, if alternatives become more successful and as they penetrate more of the advisors' portfolios, won't that sort of dilute those returns? And how do you avoid that?
So I think venture is interesting because over the past few, 10, 20 years, venture really went from a cottage industry with maybe 50 firms that really mattered to I think the latest number is there's like 2,000 venture firms. And so, you could already look at that and say, well, hasn't venture already been diluted? But I think the reality is that there's such a dispersion in venture and not all firms are created equally. And so there's still going to always be a small percentage of firms that outperform and outperform by a large margin. And so I think even if the rest of the venture market gets diluted, it's still an access play, and you still have to be in those really good at picking those firms and do manager selection really well to make those good returns. I don't think that those top firms are not going to generate good returns. I think actually returns could be really good going forward, maybe even better. There's just so much innovation happening, and there's really amazing advancements in AI that I think are going to accelerate innovation even faster than we've seen before.
Let's keep our fingers crossed for that one, John. Back to Saira. You had mentioned the concept of white labeling private alternative funds. Now, why would an asset manager or other investment provider want to do this?
So I've kind of had the dream job for the last 9 months where we've been building out a set of APIs that allows any fintech company to connect to Fundrise to offer our funds natively on their own platform. And to me, the long-term vision, that North Star that we're aspiring for, is having the ability to launch private funds for any asset manager. And I think at some point, there's going to be lots of asset managers that have these ideas, that have these theses, theses that they can launch easily and quickly through Fundrise, because we will own the full value chain in terms of being able to launch private funds.
So you anticipate more firms coming to you as a platform for launching their own funds?
Absolutely.
So would you also be the distribution for those funds?
Sure.
Would you do any validation of them, or looking to make sure they're high quality? How do you go about that?
Yeah, I mean, I think for the last 12 to 13 years, it's kind of been part of our requirement. So we stick with institutional grade quality despite the fact that we serve the average investor.
That's excellent. There's a lot to do there when it comes to compliance. Do you actually check out the advisors as well to make sure they're qualified to invest in this?
Yeah, I mean, we definitely have an advisor base currently on platform. We have our own portal for advisors, so if you're an advisor in the crowd, feel free to take a look at our advisor portal as well. But we have an entire IR team focused solely on being able to contact not only our investors, but also our advisors, and making sure that they thoroughly understand what they're doing.
Terrific. And just for everyone in the audience, we are going to take some questions at the end, so get your questions ready for our panelists. You can use the app if you know how to use it. If not, you can just raise your hand and we'll call on you. All right, over to John. Half of all advisors said client interest in alternatives has increased over the past 2 years. But are all venture capital investments the same? How can advisors get access to top-tier venture capital funds?
So short answer is no. And I think, I mentioned it earlier, but the dispersion in venture returns is really, really high. It's much higher than any other asset class. And so if you actually look at the difference between, top quartile venture returns and median venture returns over the past 20 years, it's about a 13% difference in IRR, which is just, it's massive. If you look at top decile and compare that to median, it's about a 27% difference in IRR. And so, venture, it is a risky asset class, but if you're in the best managers, you're heavily compensated for that risk. The problem is if you're not in the best managers, if you're in median returns, you're not really compensated for that risk. And so venture's not really an asset class, it's really an access class. And I think, you have to be in the best managers. Manager selection matters so much. And I think what I always tell new entrants is, you always have to ask yourself, why am I seeing this deal? Venture is very capacity constrained. The best deals are very, very oversubscribed, both direct company investments and fund investments. So if you're a new entrant, and you have access to a deal, you have to think, why am I seeing this? Why don't other people, want to invest in this? And so I think for new folks, looking to invest in venture, you have to partner with somebody who's an expert, somebody who's done this, somebody who has access. Even though Allocate's a 2-year-old company, we're not new LPs in the funds that we invest in. We've been LPs for 5, 10, 20 years in some of these funds in our prior lives. And so we're not fighting to get access to the best funds. We kind of already have access because we've been LPs for a while. And so I think partnering with somebody who has that expertise to not only get access, but also do diligence really well, to do that manager selection really well, it's critical.
I would agree with that. I know on the Allocate platform you have a very strong analytics capability. Can you talk a little bit about how advisors can use that to pick and choose the right investments that match their portfolio goals?
Yeah, so every manager opportunity that we offer on the Allocate platform has been fully diligenced. And so we do full institutional due diligence, bring every fund through our investment committee. And really the reason behind that is because we want to maintain the level of quality. as I mentioned before, we don't want to have median performing managers on our platform. We're really fighting for that top quartile. And so for advisors that log into the Allocate platform, you can see all of our diligence, both qualitative and quantitative. We do a lot of rigorous analytics, and we also host webinars with every one of our managers. And so you can listen in, you can interact with the manager, you can ask them questions, and then you can really see comprehensive diligence to kind of get a full picture of what you're looking to invest in.
Excellent. So at Ezra Group, we're a technology consulting firm. We work with RIAs and broker-dealers on the tech stacks, and we're seeing a lot more of these firms building their own tools, either advisor portals or other pieces of tech that have to integrate with the applications they have. And this week, Fundrise launched an API access to the platform. So if I'm a fintech vendor, what can I use your APIs for?
Yeah, so the APIs essentially offer a seamless experience to any fintech company that would like to access all of our investment vehicles. So you can natively access Fundrise on any one of those platforms, a few of which we'll be announcing here in the near future, where you log into the fintech platform, you see all of the investment vehicle options, and you could select Fundrise just like you would select any other investment vehicle that's available. So we like to think of ourselves as the Stripe for investment vehicles. That's kind of what we built the entire API around.
That's a lofty goal.
It is a lofty goal. Don't look at the documentation yet. We're still working on it.
Well, I'm going to look at that. That's something we want to know a lot about.
Absolutely. So if you want to take a look at what we've launched, the website is now live. The website is www.fundrise.com/connect. Feel free to critique it. Come find me after this and let me know what's wrong with it. But that we just launched that this week. So.
Yeah, we will do that. We have a wealth tech integration score where we evaluate every platform's APIs and integration. So we'll get back to you on that.
Oh wow.
It's going to be rough. But what was the driver behind building out your APIs? Was it client driven? Was it something on your roadmap? How did that come about?
Yeah, we saw a lot of other fintech companies asking us how they could access Fundrise because they were seeing the demand. They wanted to be able to offer to their investors private real estate, credit, venture capital, and realistically, there's not that many competitors in the venture space that offers anything natively on another platform. Allocate, Fundrise, we both offer venture capital, but you have to come to our platform to access it. So this was really that extending that branch to other fintech companies that want the same things, the compliance and everything wrapped into one neat little package in a very easily accessible manner.
It's more of an infrastructure play. So if I'm running a fintech and I've got equities and fixed income example that I can trade with my advisors, I can then offer alternatives, real estate, venture capital as a service, in effect.
Yes, exactly.
That's awesome. I love that. Switching back to John. So a recent survey showed a majority of advisors cited lack of liquidity and long lockup periods as the top barrier to using more alternatives. What are the ways that we can get around this?
So I think one misconception that we hear a lot when we're speaking to new folks coming to venture is that when you commit your capital, it's all called on day one, which is not true. And so when you commit $100 to a venture fund, that $100 is called over a multi-period time frame, and then you get distributions over a multi-period time frame. And so the illiquidity in venture is sometimes overstated. And if you do commit to venture consistently, eventually your commitment should become self-funding such that you get to a point where your distributions should fund your capital calls. And so your actual capital outlay is usually not as high as you think it is. That being said, venture funds are structured as 10-year funds. They usually have 2-year extensions. In reality, a lot of times you don't get your last dollar back for 15 plus years. And so venture is illiquid, but there are solutions out there to kind of make that illiquidity a little less painful. So the secondary market for venture is pretty robust. Depending on market dynamics, pricing can be sometimes really strong, sometimes not so strong. But generally, for really high quality managers, pricing can actually be at a premium sometimes. And then there are. We actually here at Allocate are innovating in some liquidity solutions and thinking about ways we could lend against illiquid positions. There's a lot of banks don't want to underwrite these type of loans because they don't understand that venture-backed companies. They don't know how to underwrite venture risk. But I think we're kind of in the unique place of we fundamentally understand venture. We understand what these funds own, and I think we can do a really good job of underwriting these type of loans and make the liquidity a little less painful.
For anyone in the audience who's unfamiliar with venture capital, can you explain what a capital call is?
Yeah, so when you decide to invest in a venture capital fund, you commit to invest a certain amount of of money up front, but that money actually isn't invested on day one. What happens is periodically over generally what's a 3 to 5 year investment period, the manager issues something called a capital call, which they'll send you a statement, or they'll say, hey, we're calling X% of your commitment now, which means you have to wire a percentage of the capital. And so when you commit $100 on day one, as I mentioned earlier, that capital is actually invested incrementally over periods rather than all on day one, and those kind of incremental investments are capital calls.
Thank you. So over to Saira. So we understand that venture capital isn't easy to get into. There's a lot of hurdles you have to jump through to get into a venture capital investment. So what are some of the ways that Fundrise is reducing friction for investments in VC funds?
Yeah, I mean, I think structurally is the biggest piece. So going back to the Fundrise mission of offering access to all of our investors, that's really the biggest piece of friction, in my opinion, in venture. So it's inaccessible partially because it's difficult to get into from a comprehension standpoint. We do extensive amounts of education, both on our platform and really in a multitude of different ways. But simultaneously, we also decrease the minimum investment amount. So if you wanted to invest in venture, you can invest for as little as $10 or as much as you'd like.
Say $10 or $10,000?
10.
10. I could put in $10 a month and go into a venture fund.
You sure could.
That's impressive.
So we, yeah, I mean, and I'm in thinking of how we kind of structurally help educate a lot of our investor base. I think about Inspectify, which is one of our recent venture investments. When we announced it to our investor base, because it's a prop tech that aligns very closely to our real estate side, which a lot of our investors are also in real estate simultaneously, there were lots of synergies. So we did a long, lengthy explanation of what Inspectify was via email. We included a link saying, hey, if you want to leverage Inspectify yourself, feel free to connect with the team here. And then our investors are also able to not only invest in Inspectify through our vehicle, but they're simultaneously able to also meet the team and potentially use that platform to help increase their valuation in the long term.
So that's interesting. That gives you a huge advantage, but you have the real estate side, and you're offering real estate technology companies as a venture capital investment that your real estate clients can use, which promotes the company, which makes them more likely to return the capital that you invested in them.
Absolutely, and simultaneously we use Inspectify ourselves, so we put that vote of confidence behind all of the investments that we make.
You're not just a president of the. You're also a customer, right? What's that? Yeah. The Hair Club for Men. Can you explain for anyone in the audience who doesn't know, maybe not familiar with real estate, what is a prop bet?
A prop tech is any company that is a technology company for real estate. So Inspectify is one of them. I'm trying to think. I mean, we're technically a prop tech at Fundrise. So, yeah, there's lots of different
property technology,
exactly.
Right?
Property
like
tech,
fintech, wealth tech.
Yep, exactly.
Reg tech, got it.
Yeah.
So, John. First of all, tell us the website name so people can go check it out.
It's really hard to remember. No, it's allocate.co.
But .co, not
.com. Yeah, no M.
That's someone else, allocate.com. Allocate.co. And what's on the product roadmap for the next 12 months at Allocate?
Yeah, I think we've got a lot on the product roadmap. We're still in the early days and building out a lot. One thing I think is really relevant to you all is we're building out a custom advisor experience on the platform. And so if you're interested in learning more about that, I've got my colleagues Dan and Peter and Austin over there. Go see them and talk to them. But in addition to that, we're really focused on building out robust analytics to increase transparency and help with portfolio planning and modeling and reporting. The venture industry is notoriously bad at reporting. A lot of venture funds are structured as exempt reporting advisors, and so they don't have a lot of, they're not held to the same standard in terms of reporting. We think that we can help change that and really increase transparency and kind of get rid of some of that reporting friction. And so we're looking to really build out some robust analytics to help make sure our investors not only can find good investments, but also know what they own and analyze their portfolios really well.
Can they import other portfolios into your platform to see how it impacts, and do some what-if scenarios?
Yes. So look, we think that we have really good deal flow at Allocate, and you can find a lot of really interesting investments. But we also know that we don't have a monopoly on deal flow, and we want our clients to be able to source deals, outside of the Allocate platform, and then still bring those in and integrate that with the existing Allocate portfolio so that they can kind of get a holistic picture of what they own across both investments sourced on Allocate and off Allocate.
All right, Saira, I'm going to ask you the same question, but first I want to open up to the audience. Any questions? We're at the 5-minute mark. Anyone have any questions for our panelists about venture capital investing in managed accounts or for financial advisors? Yes, sir.
I got a question about Fundrise. Is that a kind of fund that I could put money, like kind of like give money to you, and then you will picking those venture capital funds to the investment?
Let me restate. Your question is Fundrise a fund of funds, and someone can give Fundrise money, they'll invest it on your behalf?
Yes, so when we get your funds, we actually place it into, if you're referencing the venture fund specifically, we would place it into our venture fund. Our venture capital fund is invested as an LP in some funds. We're invested a little bit in the public markets currently, and then we're invested in a handful of companies likely to be north of, call it 10 to 15 by the end of the year.
So it's like the investors, they don't need to care about like how they're picking a venture capital, like they don't need to give the money to you guys.
No, we're doing all of the diligence, compliance, everything for you.
Thank you. Another question, sir? Yes.
Yes, I literally stumbled upon this meeting, and I think it's fascinating. I actually have the Fundrise app that I literally just stumbled upon in the whole, COVID, boredom, and having invested in crypto and winning and losing. I got involved in Fundrise because I thought, hey, it's a alternative investment. So my question to you is, I noticed that, like, I have like $1,000 in it, but since I started investing in it, it's gone down a little bit. Like, it's gone down because the real estate markets are like topsy-turvy. But my question to you is, I noticed that there wasn't an easy way to there was not an easy way to withdraw funds if you just panic. Which in a way it's good because I think there's probably some sort of built-in incentive for people to keep their funds in there. It's not like Robinhood where you could just pull money out and get the heck out. But what I noticed with Fundrise, it's a little bit more tricky to take your funds out if you do so choose. And in a way, that's good and also bad. So I was just going to say, what is your comment on that? Why is it a little bit trickier to take your funds out if you just panic, or is it more? Are you trying to encourage people psychologically to stay in it long term, almost like, hey, this is an IRA, this is a Roth, this is something that you're going to want for the long term? Because in a way, I think it's kind of brilliant the way Fundrise is set up in such a way that it's tricky to take your funds out.
So I hear what you're saying. It's actually industry standard with a non-traded REIT to have quarterly redemption. So if you're familiar with Blackstone, they have the exact same structure where once you put your funds in, you have essentially until the end of the quarter to report that you would like to withdraw. We only paused redemptions one time so far in our history. That was during the pandemic. And it was for a very brief window, but we keep a massive amount of liquidity on our platform at all times in order to ensure that we can always create the redemptions that needed to be redeemed at any given point in time.
Thank you.
So it's always possible, but and forgive me, I am not a financial wizard by any means. I don't even really, I'm just kind of a consumer. So I just wanted to say I appreciate the Fundrise platform.
Absolutely. Thank you so much for the question.
Hey, tech people, there were questions up on the screen. They disappeared. Can you bring those back up? Because we had some questions that people were putting into the Slido app. Until it comes back up, Saira, can you give us your next 6 to 12 months of your roadmap on the VC side?
Yeah, absolutely. So it's twofold for us. It's kind of a once-in-a-lifetime opportunity to be investing. So because we've seen valuations decline so precipitously, and because we've seen so many funds start shying away from investments, we believe at Fundrise that it's the best time to be investing. So we've been seeking out the companies that are generational wealth opportunities. We've been investing in them alongside Sequoia, alongside all of the big names that you've been hearing that have essentially been selling away some of their shares at deep discounts. So we've been taking that as an opportunity on our end, which we will be hopefully rolling out even deeper in the next 6 to 12 months. And then simultaneously, we have another piece of our platform called Equitize, which is our cap table management platform that is something that you can leverage whether you want to have liquidity on your platform or you just want some better management of all of your shares as a founder. So those are really the two big things that we're working on right now and highlighting across. the VC side.
All right, 30 seconds left. Last question. Anybody got one? Anybody have anything? Yes. Yes, you, sir.
So would you like to share a little bit about your philosophy to picking a fund manager or VC fund?
You got 20 seconds.
It's completely based on their thesis. It's based on their background. It's based on their historical returns. So the one that comes to mind that I'm not allowed to say publicly, he had an extensive background in venture capital. He's a brilliant person, and we ended up selecting him to add him to our investment because of who he stands for and how he performs.
John, you have 30 seconds. What do you say to that?
Yeah, I mean, look, we do all the quantitative, qualitative analysis, but I think one thing we really focus on is something called GP thesis fit. So, in tech, VCs look at product market fit. So GP thesis fit is kind of the same thing, but for fund managers, and it's really, why are these GPs the right folks to execute on this thesis? And is it a good thesis? And so, what is unique about their backgrounds, their experiences, their skills that just position them much better to execute on this thesis? And so it's all about understanding the strategy. Is it a good strategy? Is it the right strategy for these people? And then pairing that with all the quantitative analytics too.
Please give a round of applause for our panelists, John and Saira, for Venture Capital Made Easy. Thanks to Future Proof and Advisor Circle for letting me moderate. Have a great day, everyone.
Thank you.